volatility in the REIT market can be very instructive to what we can expect in the private real estate market. Looking at previous REIT corrections that took place during the financial crisis, we can see some similarities between what's happened over the past month. At the top right of the screen, you can see corrections in the REIT market based on the timing of the peak and when prices started to fall from that time period. Looking at the current correction, in about 21 days, the REIT market declined 45% in valuation. This is demonstrated by the dotted red line on the screen. Since that time period, REIT valuations have recovered to some degree and currently represent the corrections that were experienced in late 2008 after the REIT market peaked in September, fell by 65% over 39 days, then started to gain traction and then started another decline in December of that year. What's interesting here is that the stock market fell only about 20% in the first 20 days of the correction, whereas the REIT market fell by 45%. And again, since that time of falling 45%, the REIT market has recovered to an approximate correction of 30% currently. Looking at it on a property type standpoint, the best thing to look at is the devaluation by property type and the price that investors are willing to pay for a REIT relative to the value of the underlying assets that the REIT owns. This is called a share price to net asset value ratio, which we've outlined on this page. As you can see, the valuation impacts vary by property type, with industrial looking very attractive, healthcare surprisingly presenting some challenges, and retail and lodging being under the most significant pressure. What's interesting about healthcare is that at first, many investors believed that healthcare properties would benefit from the increase in demand relative to the COVID case increase. However, when we look at the composition of the REIT healthcare market, it's overwhelmingly exposed to seniors housing, long-term care facilities, and similar property types. Given the exposure to the underlying population that is the most susceptible to the COVID-19 virus, this means that investors are being very cautious about investing in this property type. As a result of that, at the end of the year, whereas healthcare properties in the REIT market were in favor, resulting in REITs that own those properties trading at a 23% premium to the value of the underlying assets, they now are priced at an approximate 5% discount to that NAV ratio. Similarly, residential, office, and retail have also experienced declines in relative valuations. What does this tell us about the private real estate market? Many investors believe that what happens in the public real estate market presages what happens in the private market. And if you'll remember, I mentioned that REIT valuations have recovered to approximately a 30% decline since bottoming at 45%. Moody's Analytics publishes the Commercial Property Price Index, which is outlined as the CPPI in the light blue line on this page. What they are currently forecasting is a decline of approximately 25%, with property values bottoming in early 2021 and then needing 2 years to nearly recover to pre-COVID-19 valuations. This is relative to the Housing Price Index, which the Federal Housing Finance Agency forecasts, which shows a more moderate decline.